So our first panel of the day is on the quest for liquidity. How can the market achieve stable, bright liquidity in equities? Now, of course, that makes you think, well, what do we actually mean by stable and bright liquidity? Has the market already achieved that? And if it hasn't, what are the challenges of overcoming that? And let's put that into some context. So since 2007, when MiFID came in, we've seen the market fragment significantly. A proliferation of new trading venues coming in, whether they're lit pools, dark pools of all sorts of different types, new participants coming into the market, more proprietary trading, high-frequency trading, growth in algorithmic use, and the introduction and increasing sophistication around smart order routers. The buy side and brokers increasingly focus on TCA, whether that's to demonstrate best execution or to assess and analyze broker performance. And the buy side have never had kind of more tools on their desktop to help them and enable them to navigate their way through an increasingly complex marketplace. And all of those trends developing with the backdrop of the financial crisis, numerous scandals, technology glitches. So I shall take my pew over here amongst our panelists. And Christian, the first question is for you. But let me just introduce my panel first. So we have Christian Katz, the CEO of the SAX Swiss Exchange. And then to my left, Rob Boardman, CEO of ITG. And then Richard Seamark, MD at UBS and the CEO of their Dark MTF. And then we have Fabien Arev, who is Global Head of Dealing at Candriam Investors Group. So no doubt some very familiar faces among the panel. And as I said, I will start with Christian. So do you think that we're going in the right direction with the market structure in Europe? And is it your view that the exchanges are doing enough and enough of the right things to ensure that we have stable, orderly, and fair markets?
Good morning to you. I think thank you for the question. In general, I do think that we are under the umbrella of what we would call MiFID II. We're going to a better world for equities, in particular non-equities, but on the equity side as well, given what happened after 2007 with the introduction of MiFID. So I do think we're going into a world where we're trying to overcome some of the problems which came out of MiFID I. And it's not so much that the regulation per se, which is partly deregulation in 2007, that was a sole problem. I think it hit the financial crisis pretty much with the same timing, which led to some effects which were not desired. So in general, I do think we're going to a world where we have some rectification of the problems. And does that really mean that we are now going to achieve stable, bright liquidity in equities? I'm not sure. I think we already have pretty much stable and bright liquidity in equities, and the key is not to lose it. So I completely agree with our keynote speaker from before. Liquidity in equities is not that bad. I think it's some issues are there around blocks about splitting up trades into very, very tiny pieces, and some of the speed issues need to be dealt with. But in general, liquidity is quite high depending on the market, but on our market, say, we're not worried about lack of liquidity. We have pretty deep liquidity.
Mm-hmm. Okay. And Fabien, what's the buy-side perspective on this? Do you feel as though the market has just become too arcane, it's too complex, it's too difficult for us to really know what's going on?
Yeah, I think I'm trying to get optimistic in that challenging environment. Just to remember a bit of history, fragmentation and competition of venues have reduced explicit costs for institutional investors. And with fragmentation, a a very large offer of algos came into the market, and investors like Crandriam gain much productivity. So that's one aspect of my optimism. But fragmentation is a very big challenge for the execution of large size orders, because the average trade size dropped in many markets, in many venues. And I think if you trade everything with a smart order router today, you probably expose yourselves to higher implicit costs. But if you look at your transaction costs and you try to determine where to trade blocks, when to trade in the dark, or what to trade with algos, I think you can keep implicit costs at a reasonable level. So my answer is mixed. I think that complexity, fragmentation, has got some, I would say, positive impact on the global performance of my trading desk. But it's been a very long way. It's been hard work. It's been lots of efforts. And it's maybe something we have not mentioned yet. We have to get more disciplined to tackle complexity.
And following on from that, like what do you think the role of TCA is? Perhaps a question for you, Rob. You know, TCA has been increasingly used, and there's been a lot of effort put into improving them. That as a tool to be able to, you know, understand the performance and the capability, whether it's, you know, across the buy side, or, you know, as you choose which brokers you want to use and which algorithms and so on. But is it really possible to use that kind of toolkit to understand what's really going on and to influence the behaviour then in how you execute your order flow in the marketplace? Or do we need something else that we don't currently have?
I think it's a great part of the toolkit in two different ways. I mean, back to the point about implementation costs. Implementation costs for our industry have been falling continually over the past 2 decades. We think mainly a result of the market becoming more electronic and more efficient. There was a spike in implementation costs around the financial crisis, with the extreme volatility that we had was generally unfavorable to asset managers. But I think that's interesting because it shows you that it's not just the volume of transactions and liquidity that were around that is useful, it's the quality measure as well. So it's no good just having a lot of people trading. If that environment is not favorable to fundamental investors, then you'll get a negative result in terms of transaction costs. In terms of the micro, to answer your question, I think we believe that there is useful data that can be mined at the single manager level about their past results of dealing with various brokers, various strategies, various venues. And we've shown, I think, that there is some reusability to that past data. If you look at what you and maybe your peers have achieved trading in various ways in various stocks, it is not going to guarantee, of course, an outcome on any one day. There's a lot of randomness in markets. But that data does provide a bit of a signpost as to what might be the best strategy on any given day.
Okay. But it always seems just nigh on impossible to really know what's happened to an order. And this was referred to in the kind of earlier talks that we had. So, Richard, do you think we have enough transparency in the marketplace in terms of order handling? And what happens when the order leaves the buy side and then makes its way through to the market, given the complexity and the various different venues that exist and so on?
Well, I think that's the positive outcome of Flash Boys and the focus on the structure of the market and high frequency trading, is it's getting the right questions being asked. I'll happily disagree with anyone on the panel to get this going, but looking at TCA, I think it's really not about looking at individual managers. It's now about looking at individual orders. What happens to your order when you send it to a broker? Where is that routed? What are the preferences that the broker expresses? Not just where do you trade, but where don't you trade? Because information leakage is not just the executions you do, it's much more about the executions that you don't do. And I think that level of analysis is now available. Many brokers will be able to provide that information, either directly to you or to your TCA providers. So I think we're getting the level of transparency if the right questions are asked.
Okay.
I think coming back to the stable and bright liquidity, it's not surprising that Christian wants to talk about bright liquidity. I think if we listen to what Matt Lyons said earlier, what he was talking about is a situation of how much to disclose, how bright should liquidity be. And I think it's important to always keep in mind that you've got this balance between the brightness of your liquidity and your ability to get a trade done. And that gradual building up of confidence, which is the way to try and address that trader's dilemma, is something which is very difficult for an exchange to do. So this ongoing battle as to whether exchanges or brokers are the ones who are providing execution, I think one of the things that brokers can do is to help build the level of confidence on two sides of a trade to get those blocks put together. And that's not solved by brightness or transparency.
Okay, so you mentioned confidence there, and you also referred to the book that was published just over a week ago, so Flash Boys by Michael Lewis, right, which contains some potentially explosive comments around the quality of the marketplace, primarily referring to the States, with a fairly bold assertion that markets are rigged. So what are people's comments on this panel on that subject?
Again, I'll just come back to, I don't think there's actually a ton of new information in the book. I think it's primarily designed to create debate and to inform people outside our industry, and it makes a good read, I guess. But again, in terms of, we always say never let the data get in the way of a good story, but when you do look at the data, it doesn't really jive with that picture of markets being rigged against the end investor. Markets have become cheaper for investors to trade, both at a retail level, in terms of looking at narrow measures like spread, and at the institutional wholesale level when looking at the cost of implementing block trades. So it doesn't really square. And I think there are some questions for the industry to ask, and we're always evolving. But I'm not quite sure that we should just conclude from this one book that our industry is broken. I really don't believe it is.
Mm-hmm. Okay. Now we see, and Richard just referred to this, the evolution in the marketplace where brokers are becoming exchanges are becoming brokers. We're seeing the buy side take greater control over their execution. So there's a kind of general blurring of the lines in terms of people's business models. Christian, why do you think that's happening, and do you think that's really adding benefit to the institutional investor?
I do believe that our model as an exchange, we haven't gone to become a broker. There are some broker firms which have started to create venues, and since the new regulation allows them to do that, I think it's a legitimate way of trying to broaden their reach. But we as an exchange, we haven't done that. I think, when you work at an exchange place, your perspective becomes a bit longer. You don't think in days or months. You take decisions, you create platforms, you create security checks which are there for 3, 10, 15 years. And that's why, in the long run, you build a reputation which is very delicate, and you need to protect it. You need to be, the kind of like stable backbone of a whole financial market that is much bigger than the exchange. We're just a little backbone in the end, but we're like a very solid backbone. So I don't think our aim is or should be to necessarily venture into the brokerage side, but I think we should enable to offer and to bring together liquidity. It doesn't have to be only bright liquidity. This is obviously the title of our speech this morning, of our discussion, but I think it can also be dark pools, deep pools, large block pools that we open up. And I think, so we're facilitators for a business. Let me give you an example. We started trading last year, the beginning of last year, we started enabling the exchange trading of mutual funds. So like, Capital Group mutual funds and the lot. So we have, how does that work? We bring together market makers to make prices in mutual funds, which normally you can only buy and sell with the fund company and get an end of the day NAV pricing. But if you can, trade them on exchange, then you have like instant pricing, instant execution, instant transparency. And we have 2 market makers now. We trade hundreds of funds, and that's only possible because of some of the things like fast market making, arbitrage, because the people who make prices, obviously they don't trade exactly into the mutual fund on the same day, but maybe they hedge it through an ETF, through a future, through baskets, and they provide to the buy side what the buy side likes, like instant liquidity, but they manage some of the execution risks on the back. So we just provide the platform. We don't do the market making, but I think we enable a business for market makers on the one side, and many of them are electronically led market makers, and on the other side, clients who like to have a little bit more execution capability than just end of day, kind of after the close NAV pricing, which is late, intransparent, and hard to kind of deal with in your risk management systems.
Okay, Richard, question for you. So you're CEO of the UBS MTF, which is one of the biggest dark pools in Europe. What was the driver to decide to open the dark pool up in that way and under that structure? And as we've seen more and more pools of that sort coming into the market, that's in effect increased the fragmentation across numerous dark pools. So do you think we need to be doing more in terms of re-aggregating that liquidity, and what would be the right approach in doing that?
Well, I think typically brokers are the method that clients use to re-aggregate the liquidity. I think fragmentation in itself is not a problem. It's how that's put back together and what costs it generates. So I think if we see the same sort of competition in the post-trade space that we started to see in the pre-trade space, then we can address those problems. The reason that UBS set up an MTF was really to be absolutely definite and clear about our own liquidity strategy. There's a lot of competition between brokers, and the brokers try and differentiate themselves, and we felt that the best way of doing that was to make a very clear distinction between the liquidity that trades within the broker in PIN, in our crossing process, and the liquidity which is broader, which trades within UBS MTF. So we're very restrictive on the liquidity that can trade within PIN. But there are a lot of other types of liquidity that would like to interact with that flow. So once it's had the opportunity to go through UBS PIN, it can then move on to UBS MTF. The reason we set that up is partly a response to what we perceived in the market to be some suboptimal outcomes with many of the other venues. So we felt that if we set one up ourselves, we could address things like cost, like post-trade competition, but also have a venue which we knew and understood and could hopefully, as we've seen, build that to a level where it provided useful liquidity. But the reason for setting that up is the same reason that UBS trades for clients. It's to give a better execution outcome for our clients, because we're competing with many other brokers for our clients' business.
Just to get back to his point, I think the aggregation of liquidity will come from 2 different sources: consolidation and initiatives from primary exchange. And on that consolidation aspect, I don't think consolidation amongst venues will come only from the fact technology costs have become very high, and because small venues struggle to gain liquidity. I think the main reason for consolidation coming is definitely the buy-side commitment to venue selection. Most of my peers and ourselves have asked our brokers for more dialogue, more transparency, more customization of smart order routing. And maybe I can be controversial with what you said, because I mean, we're very agnostic between PIN or MTF. It just, we need to know if your venue offers a decent level of protection. And it's our request to discuss the detail of that customization. And this venue selection is based on the venues we know best, on the back of, and I come back to Rob's point, is TCA. So that's one thing. The other thing maybe is for Christian. Maybe I think your value today would be great if you consider to aggregate or to take the chance to aggregate liquidity and to think about introducing an intraday auction. And I think it's very interesting because it only exists in Germany. In the UK, there is a consultation paper that is ongoing. And from my experience, this would help concentrate liquidity and facilitate trading in size at a particular point in time. And there is another auction-related thing that I think is very interesting, is a trading at last phase, which is the possibility for investors to trade amazing amount of stocks over the 5-10 minutes after the closing time. And if you look at the market in Europe, I think it's only Euronext, LSE, and Borsa Italiana where that phase takes place. And I think that mechanism should be extended to other exchanges to improve liquidity.
Yes, thank you for trusting us to do something good for the market. We have a very deep auction, and we've been considering introducing intraday auctions more than once. We haven't said that we're not going to do it, but we didn't see much of a need from our clientele, because actually our venue in those stocks that are traded on our exchange, we usually are 75% of the time we are the best bid, the best offer, the largest size on the bid, and the largest size on the offer. So we have like a very, very good liquidity statistic. But what we have done, we've just introduced this Monday, 7th of April, in other words, yesterday, we introduced a new order type, which is market on close, so that you can, during the day, you can say, you decide that you want to have a large part of your order actually traded in the auction. You can fix that already during the day. But I think that in this sense, we're thinking about optimizing the auction, which is obviously the most liquid time that we can offer. One way is intraday, another way is like, as you say, creating order types that after the auction or before the auction manage to kind of extend that liquidity for a longer time. But I do think, if we step back a little and we think like what's going on, you mentioned the Flash Boys book, which I guess many of us will be reading in the next couple of weeks. Are we really in a new phase in Europe? Dominique Ceruti said. I think we are, and I'll tell you why, since we have this discussion about execution. 11 years ago, right, 2003, April 2003, there was a big paper coming out from the FSA, the UK regulator, which in the meantime doesn't exist anymore, not the FCA, but the FSA put out a paper called CP 176, Consultation Paper 176. It was after the internet boom and bust that they decided that, the commission that the buy side was paying to the brokerage side was not transparent enough, and that it had to be split into payment for research and payment for execution. That was the aftermath of the internet bust. And 11 years later, what has happened? Well, execution, since you had to split those commissions, which at the time were about 20 basis points, execution became an art, a very fine art. And so what we're seeing today is like the electronic, manifestation of that art, because the brokerage side continued to provide value to the buy side, but they had to be better and electronically more sophisticated. And where we are today, 11 years later, we are in a, after the next bust, which happens in markets, so usually go up, there's a little bust, and we move on. And now we're in this phase where we've had the bust, and we will probably rectify some of the things that happen now, like the execution, has become such an art so fast, a little bit tough for regulators to understand what's going on, how to surveillance it, especially cross-border, how to go after it in a criminal investigation like we're seeing today in the US. So I do think we're entering a new phase where, like 11 years ago, we're trying to rectify some of the intransparency about research and execution payment. Like 11 years later, we're here and trying to rectify some of the things in speedy electronic execution. We won't stop it. I think we'll be more sophisticated, but we'll put some of the guidelines and buffers so that the new phase can continue to grow without maybe some of the doubtful things that may have happened in the last few years.
Yeah, if we look at our history, we'll probably put some things right, and then we'll also introduce some unintended consequences and some other things that don't quite go the way we want them to, and we'll rectify them at some other point further down the line. We're running out of time, but I'd like to ask the audience if anybody has any questions for our panel here. See any hands going up? Aha, at the front here, please. If you could say your name and company.
Sure. Dan Barnes, I'm a journalist with Bob's Guide. I was just wondering if you thought perhaps brokers should drop the HFT clients that they have so that when they talk about satisfying clients, they're only satisfying, say, long-only clients or hedge funds who have a genuine long-term investment strategy.
Brokers?
I think that's it's absolutely crucial to understand how high-frequency clients are treated by your broker. So if they're separate, if high-frequency clients are using your pipes to access the market, then I think that's one thing. If you're giving them some preferential look at your institutional order flow, I think that's a real problem. So the answer to your question is yes, those are exactly the questions that people should be asking their brokers, and understand if they have high-frequency clients, what information they're getting from them. In exactly the same way that part of what's in the Flash Boys book is asking the exchanges what information they're giving to those high-frequency clients. I would agree that broadly my view of high frequency is fairly neutral, but what I do have a problem with is them getting preferential treatment, preferential data, preferential latency so that they have an inbuilt advantage. And I think it's important that we're aware of where that's taken place, which I think, to be fair, is much more in the US than it has been over here. But those particular order types and those premium data feeds have caused a problem and are unfair. And exactly the same applies to brokers.
I'll just offer you another perspective on that, which is I think many of the largest brokers and firms providing execution now offer very low latency technology directly to their asset management customers as well, implicitly through algorithms and smart routers, which are now in some cases approaching some of the same speed as some of the HFT firms. So you have to ask the question, those lines may over the next 5 years even blur. You've seen, certainly if you believe the tab numbers, that the proportion of European liquidity that is caused by HFT firms and the amount that they participate in as a fraction of the whole has actually dropped over the last 5 years. And one of the reasons I believe for that is that brokers themselves have caught up in the technology arms race. So I think those lines may well blur at some point, and I welcome that because I think that's a democratization of markets. I think that asset managers, when they place an order to a broker, are doing nothing more, certainly if they give them an algorithmic order, are actually pitting that broker versus the other HFT firms in the market. And I think as that arms race becomes more of a race of equals, then I think the odds will move more towards the asset manager and away from the HFT firm. I think the returns will still be there for the best HFT firms, but that war is now a lot more evenly balanced than it used to be.
Yeah, thank you for the question. I will try to give you a typical example of what we experienced recently on my desk. When we receive large market orders early in the morning, we do not see any IOIs or we don't see any significant activity. We do not take the risk to work in a lit market and get detected by other market participants like HFT who will jump in front of us. Okay. In that case, we use a dark liquidity seeking algo with minimum field size. But it doesn't mean it's an end, because when volumes and volatility grow later in the morning, we can take the decision to accelerate the execution and go back to the lit market and pay the spreads on the lit order books. So I think it's a complementary approach to this. As long-term investors, we accept diversity in liquidity and market participants. The thing is, we want also to escape them when we want to do so. We want to interact with them when we think we have to get more aggressive in the market.
Okay, thank you. Time for one more question, just quickly, if anybody's got one. In the middle there.
Yeah, hello. Yeah, Victor Le Breton from Quant Hedge. We have seen a surge of the repo market these last 2 years. Do you think it has some relation to the liquidity seeking or new ways to find liquidity?
I have not got.
Can you repeat the question?
Yeah.
I don't think I heard it.
There is a surge in the activity in the repo and borrowing market in the equity and stock. So do you think it's related to the new ways of finding liquidity in the market and trying to get other ways of finding these stocks, and not only in the execution side, but in the borrowing side, for instance?
I think there are increasingly diverse strategies for generating returns. If we go back 15 or 20 years, most funds were pitted against a particular index and trying to outperform that index. There are now many more multi-asset funds, many more absolute return funds, and those generate a need for different types of trading, and particularly for shorting as well as going long stocks. And I think that has generated a constant increase over time in the need to borrow stock. Also the efficiency of the market, and as we move to T+2, this will become even more so, generates a need for borrowing stock. So I think that's a natural development of the market becoming more efficient and more optimal. I think the idea that that's in some way causing problems for the equity market is one of these fads and fashions that comes and goes. So you'll see when markets are performing poorly, you'll see a lot of comment about shorting of stocks, which is normally taken in isolation. I think many of those strategies, as I say, are part of broader absolute return approaches as opposed to some kind of negative approach to the market.
I'd say that if you look at the amount of money that's gone into equity long short over the past 18, 24 months, I think that's probably one of the major drivers, certainly of the equity stock loan market. That and a consequence of ESMA's prohibition on naked shorts at the short end to facilitate settlement. Those are probably two of the main reasons why you've seen that. And I think we should, not be unhappy about that. I think it's a sign of a healthy capital market is to have, a liquid stock loan environment.
Great.
But I think generally a point that's worth making is many of the things we're talking about are the sort of innovations that when trade tech started, whatever it was, 12 or 13 years ago, we were looking forward to. I think the concern that maybe we'll address over the next couple of days is that many of those innovations are now being constrained by the regulators as they respond to the perceived problems of the last few years. And of course the issue we have in Europe is that our regulation comes around once every 10 years, and so you have a snapshot in time with all the political views at that point, and then we have to live with that for 8, 9, 10 years afterwards. And I think that's definitely a concern, that the natural innovation and development of the market will be in some ways constrained by MiFID II.
We will definitely be hearing more and debating more about regulation over the next couple of days. So could please join me in thanking the panel for their expert comments. Sure. Thank you.